Week 7, Chapter 12, Part 2, the Capital Budgeting Decision. So let's look at selection strategy. All non-mutually exclusive projects having an NPV equal to 0, which also means an IRR equal to cost of capital, should be accepted under normal conditions. If the NPV equals 0, it means that the company will earn its cost of capital on the project. The NPV method and the IRR method always agree on the accept or reject decision on non-mutually exclusive projects. A disagreement may arise between the NPV and IRR methods when a choice must be made between mutually exclusive proposals or when all acceptable proposals cannot be taken due to capital rationing. The primary cause of disagreement is the differing reinvestment assumptions. The NPV method inherently assumes reinvestment of cash inflows at the cost of capital. The IRR method assumes reinvestment of cash inflows at the internal rate of return. The more conservative net present value technique is usually the recommended approach when a conflict in ranking arises. There is also a modified internal rate of return, which is an alternative calculation to the IRR and NPV methods. All cash outflows are discounted to the present at the firm's cost of capital. All cash inflows are converted to a terminal value by compounding them at the firm's cost of capital out to the end of the project. And the discount rate that equates the future value of the inflows growing at the cost of capital with the amount invested is the MIRR. Table 12-9 demonstrates the method for calculating MIRR using the rate function on Excel. Here we see the MIRR for investment B for you to review. Capital rationing is the management may implement capital rationing by artificially constraining the amount of investment expenditures. Under capital rationing, some acceptable projects may be declined due to management's fear of growth or hesitancy to use external financing. Under capital rationing, projects are ranked by NPV and accepted until the rationed amount of capital is exhausted. The net present value profile includes the characteristics of an investment that are summarized by the use of the net present value profile. The net present value profile can be used to reinforce the inverse nature of required rates of return and present value interest factors and the resultant impact on discounted cash flow streams. Here is a graphic depiction of net present value profile for your review. And here's another net present value profile with crossover happening. Remember that the net present value profile provides a graphical representation of an investment at various discount rates. Three characteristics of an investment are needed to apply the net present value profile: the net present value at a 0 discount rate, the net present value of the project at the normal discount rate, or cost of capital, and the internal rate of return for the investment. Here are categories for depreciation write-offs for your review. Here are some depreciation percentages expressed in decimals for your review. Here is a sample of a depreciation schedule. And here's an example of an actual investment decision with an assumption that $50,000 depreciation of machinery with a 6-year productive life produces $18,500 of income for the first 3 years before deductions for depreciation and taxes. In the last 3 years, income before depreciation and taxes is $12,000, and the corporate tax rate is 35% with a cost of capital at 10%. For each year, depreciation would be subtracted from earnings before depreciation and taxes to arrive at earnings before taxes. Taxes are subtracted to determine earnings after taxes, and depreciation added to earnings to arrive at cash flows. Here is a graphic depiction of cash flow related to the purchase of machinery. And here is the net present value analysis for your review. With the replacement decision, the investment decision for new technology includes several additions to basic investment situation. We need to sell the old machine. Of course, there are tax consequences, and this can be analyzed by total analysis of both old and new machines, incremental analysis of cash flow changes between old and new machines. The sale of the old asset provides cash inflow based on the sales price and related tax factors. For the tax factors, the book value of that old asset compared with the sales price would be used to find the taxable gain or loss. A loss can be written off against other income for the corporation, but the gain is taxed at the corporation's normal rate. This graphic shows you the book value of an old asset and the net cost of a new asset. Here we see incremental depreciation benefits based on cash flow analyses on the basis of incremental gain and depreciation, related tax shield benefits, and any cost savings. Here's an analysis of the cost savings benefits for your review. Here is a graphic depiction of the present value of the total incremental benefits, which brings us to elective expensing, which is about a business being able to write off certain tangible properties if purchased in a year for up to $250,000 under the 2008 Economic Stimulus Act. This is very beneficial to small businesses, and this allowance was phased out dollar for dollar when total property purchases exceed $800,000 in 1 year. This is the end of Chapter 12, the end of your lecture series for Week 8, and I wish you the best of success.